Hi, it's Chris Titley here. As part of the Sub 11 Uncovered podcast series, I'm joined by Evan Thornley, co-founder and CEO of Longview. Evan, thank you so much for being part of this series.
Thank you, Chris. Good to talk to you.
Evan, I'm keen to get the listeners to understand a little bit about your background and your history within the technology space in Australia, and then how you formed Longview and why.
Yeah, sure. I'm one of those dreadful industry veterans these days. So put the first Australian tech company on NASDAQ back in 1999. So before many of your listeners were born, I expect. And, took it to 14 billion in market cap, which was proper money in those days.
Still is.
and then dual listed it back on the ASX and a whole bunch of other things. So that's something that some people are familiar with from a certain vintage and others not so. But was sort of right at the early stages of the Australian tech scene, and I've enjoyed watching it grow and develop, and seeing huge, great companies like Atlassian and Canva and others that have come forward since. I'm a serial entrepreneur, so both social ventures and businesses. So I cooked up the idea of a non-profit consortium buying the entrails of ABC Childcare and turning it into Good Start, which is now the largest social venture in Australia. So my colleague in that, Michael Trail, deserves most of the credit, I should say, for actually making that happen. But I helped formulate that in the early days. And but for the last 9 years, I've been cutting down the jungle in residential property and housing and try to figure out how we fix this mess. And I think we've taken 9 years to get to the starting line, but we've got a real play now. So hopefully we should be an overnight success by about year 15.
Fantastic. And Evan, Longview, the name, the iteration and the business concept going back those 9 years, day one, how did it all begin?
Yeah, well, let's start with the name. I mean, Longview, property is a long game. And what's so bizarre about property is that all of the major industries and therefore all of the major companies that are associated with residential property are short-term transaction focused, whether that's developers or sales agents or portals or the banks for that matter. Even the banks, let's be honest, right? They're churning those loans every 3.5 years, whatever it is now. So there is no one in the entire ecosystem who is focused on the long-term performance of those properties. And yet that's the whole game. So, we love our name because it really speaks to what we're on about. And, let me just put context around that, right? Every property market in the world is a trade-off between capital growth and yield, rental yield and capital growth. Australian resi, particularly in Sydney, Melbourne and Brisbane, is arguably the best capital growth market in the world. Right, certainly on a sustained basis over literally multiple generations, which also means, by the way, it's one of the worst rental yield markets. So the only thing that matters in investing in resi property in Australia is long-term capital growth, but it's really good. But so that's what you've got to focus on, and there's almost no boats on the water. And that's strange to begin with, but just consider this. The capital growth on Australian resi property just this year, just the capital growth, not the underlying 10.7 trillion of asset value, just the capital growth this year and most other years is the same size as the entire federal government budget.
Right, just this year.
$680 billion, right?
Yep.
That is 4 times the size of all the earnings of every company on the ASX combined. Okay, so the biggest wealth generation engine in this country by the length of the straight is capital growth on Australian resi property, and there's no boats on the water. There's 2.5 million landlords who are out there one by one in 71% of cases owning one investment property. And of course, there's all of us in our own family homes, which ironically tend to be the better investments than the investment properties. So, when you say where does Longview come from, it starts from that sort of startling observation that despite being the biggest industries in the country surrounding residential property, particularly if you include mortgage, no one has a focus on capital growth, and yet it's the best capital growth engine in the world. So you kind of start from there, and then you look at all of the social issues associated with housing right now. You've got a purchase affordability crisis. If you don't have the bank of mum and dad, it's almost impossible for people to get in. So housing's becoming an inherited privilege. Home ownership's becoming an inherited privilege. You've got a crushing rental affordability crisis. and you've got the worst rental environment in the Western world, the shortest average tenure. So, part of our business manages 4,000 rental properties. Probably a third of our clients are, sole parents with kids, and they're moving every 20 months. It just catastrophically bad for those families. And none of that is good for landlords. So you have this irony of the private rental market works neither for renters nor for landlords. We published a series of white papers on how the property market really works, did them jointly with PEXA, the electronic conveyancing giant, because they've got all the data and we've got all the analysis. And, the second of those outlined, we did analysis of our own landlord clients' investment returns. And, on average, the landlords of Australia are only getting a 6% return on their capital, total returns.
Right.
They would have been better off putting their money into a balanced super fund.
Yep.
And yet there's great returns available in resi property, but the landlords are investing in the wrong assets and in a market that is dysfunctional. And so you've got a system that's not working for renters, not working for landlords, and not working for home buyers. So that's the problem set that Longview's been trying to solve over the last 9 years, and I think we're starting to get there.
And the solution of that problem, an investment vehicle where people can invest in Australian residential property. Can you talk about that with Longview, and why haven't there been too many, as you talked about, boats in the water? Yeah,
well, look, so we think that a central way station on the road to solutions is the creation of a housing fund industry in this country. Pretty much every other civilized nation on earth has a housing fund industry. We have a superannuation industry, right? Or a pension fund industry, as they call them in other countries. The purpose of that is to deliver dignified, secure retirement, and that's good. And we have a super system that's the envy of the world. But they're not housing funds, and we shouldn't try and turn them into housing funds. Housing funds are in the business of delivering dignified, secure housing. It's a different set of skills. It's a different risk profile. It's a different thing. Pension funds invest in housing funds as part of a balanced portfolio across asset classes. And indeed, our super funds invest in housing funds everywhere else in the world except in Australia because there are none. So our point is you need a housing fund system so that investors, whether they're landlords right up through to institutions, can invest in the asset class, and where you separate the financial flows of investment from the physical ownership of the assets, let alone the occupancy of those assets. Right now, those things are completely intertwined, and it creates a broken system for everybody. So once you separate that, people should be able to invest into and out of the asset class as they see fit through fund structures, through primary and secondary markets in unit trusts in funds. And those funds can make long-term investments in housing, whether that's in helping owner-occupier people through shared equity, or in large-scale long-term rental funds to deliver dignified, secure rental. So we're trying to pioneer the growth of a housing fund industry, and there are a number of others who share at least part of that vision. But that's really I see no solution to Australia's housing problems without that, and I don't really see a scalable investment opportunity for people until you've got a proper professional managed fund structure and product.
Evan, coming from a background of working in shares, you can buy and sell shares that are liquid every day, and there's an attributable value on the share market per se. When it comes to a housing fund, thinking out aloud here is like in terms of investing in different houses. I mean, the old sort of quote was, you can't sort of buy a bathroom or buy a part of a house. Can you talk about how the Longview Fund works?
Yeah, sure. Look, the great news about residential property is in at least 95% of homes, you can value those assets on any given day, sort of plus or minus about 2%, right? Like this is not regional shopping centres, right, where it's worth 680 million one day and you have a change in cap rate and suddenly it's worth 480, right? That's not how housing works. It's not how resi property works. So the assets themselves are very easily valued, and the value can be updated at any given time, quarterly or with whatever cadence you want to do that. And across a portfolio of hundreds or thousands, you've actually got a very steady kind of net asset value capacity for any fund. So I don't think that's the difficult part. So look, the way these things work in the US in particular is you create a large portfolio that becomes what I call self-harvesting. Okay. Once you've got hundreds of properties in a fund, then the reality is a portion of those properties are sold every year. And or if it's a shared equity fund, those clients buy out the fund and buy back their share of their capital growth. So through those mechanisms, the fund becomes self-harvesting. The book throws off actually quite strong cash flows, much stronger cash flows than individual property investments do. I mean, most resi property in Australia, the holding costs are negative, right? Particularly if you're buying property that has high capital growth because it has a strong proportion of its value in the land, then you're paying high land tax. You've got gearing against the asset usually, and so with high interest rates. So for most people to invest in residential property means a long negative holding cost period, and then hopefully if they bought the right asset, a strong capital growth prize at the end. Investing in a capital growth oriented fund, you'll get the realisation of that capital growth on an ongoing basis. So we think our fund will probably deliver 15% money on money returns from about year 3 onwards, and rising from there. So people can get the sort of the diversification and the cash flow they want from the asset class, without us messing with where people live or how they live or selling them up or doing any of the other things that you don't want to have happen in a housing system. So generically, that's how capital growth oriented funds work. Our first fund is a shared equity fund, so we're co-investing with homeowners, either home buyers or homeowners. And the way we do that is we give them access to equity for their home or from their home in exchange for a share of their future capital growth. So it's very friendly money for the home buyer or homeowner. This is not a loan. We are not a bank. There is no monthly servicing. You can't default on us. We can never throw you out of your home. So it's quite life-changing for a lot of those clients. The flip side of that is, though, we do get a fair share of your future capital growth comes back to the fund. And so typically, in most cases, our deal with the client is that the fund gets about 1/3 of their future capital growth. So that means that the homeowner or home buyer, they're only giving up $1 to the investors if they themselves have made 2. So it's a very aligned structure, but it means that the investors are getting a multiple against the capital growth of the property. So, a typical situation is where we would invest equity equivalent to about 10% of the value of the property in exchange for a share of future growth of about 1/3 of the future capital growth. So that way, in a very aligned structure, we only do well if our clients do well. We only invest in assets that are likely to get high capital growth so that we can both do well. But then the investors are getting a really strong return on their investment with no risk, no debt, no leverage in the fund. So very low risk, diversified investment, and a self-harvesting profile across that portfolio so that it throws off much stronger cash flows than they could get through individual property investments. So, we are the top-rated rental property manager in the country. Out of 47,000 real estate agents, we got voted the best large property manager in the country. We know the lives of our landlords intimately and the challenges they have with being individual property investors, and we really created this fund to give people a far more effective way of investing in residential property than buying individual properties. So stronger returns, greater diversification, stronger cash flows, no holding costs. We're co-investing with homeowners, so there's a principal place of residence exemption, there's no land tax. It's just fundamentally a better way for people to invest in the thing that we all know and love, which is family homes in Australian resi property.
Just on that topic in regards to geographic location and the types of property, when you think about residential property, I can think about townhouses, think about units, think about houses. What's your particular focus and the due diligence that Longview does?
So look, we just had a nice piece written up in the Oz, which we created a word brand to describe our investment approach, which we call RODWELLS, robust older dwellings on well-located land.
There you go, RODWELL.
So
it's the first time I've heard that
for you. Yep. This is a really simple investment thesis. It couldn't be simpler, but that doesn't mean it's not powerful. Australia has the second highest population growth rate in the world and has had since before any of us were born. And it pairs that with the highest level of urban concentration in the world. Almost all of that population growth has and continues to keep happening in just 3 urban centres, Sydney, Melbourne and Southeast Queensland. And what that means is that the value of well-located suburban land for 100 years has doubled every 8 years.
Right.
And so land appreciates, buildings depreciate. The properties with the strong capital growth are the properties where the bulk of the value of the home is actually the land underneath the home. Or as I like to say, we invest in dirt disguised as houses. So if 80% of what you've paid for a home is actually the value of the dirt underneath the home, then that 80% of your money is appreciating quickly, and only 20% of your money is depreciating gradually through the depreciation in the dwelling. So that's a simple investment thesis. It couldn't be simpler. If nothing changes from the trends that have been going for 100 years now, the value of that suburban land is going to keep increasing, and we get a multiplier against that growth rate. When we talk about robust older dwellings, I say we invest in RODWELLS, not ODWELLS. All the values in the dirt, all the problems are in the buildings. So what we don't want to do is invest in something that may be sitting on a beautiful piece of dirt, but is not a good home. It's going to, cause all sorts of troubles for our home buyer or homeowner, and all sorts of management headaches and potential costs for the fund. So, we only invest in 12% of the assets that come to us. And what we're doing is making sure that we're seeking to invest in assets that are likely to be in the top half of the capital growth distribution and are not likely to have any major sort of troubles or costs associated with them for the homeowner or home buyer or for the fund. So that's what RODWELLS are. That's what we invest in. We're very selective about the assets we invest in. But so far, I think we're now invested in 40-something family homes across Sydney, Melbourne and Brisbane from $800,000 to $4 million. And they're quality family homes. They're not crappy investment apartments. And, the irony of our business at Longview with our rental management business is almost every client I talk to have made a better return on their investment in their family home that they bought for lifestyle reasons than in the investment property that they thought they were buying to
for
make
investment
money.
reasons. Yeah. Yep. There you go.
Right. And that's even before tax, right? And then
yes, because it's pre-tax, of course. Yep.
So when you say to people, well, why wouldn't you invest in quality family homes? Then they're a better quality asset. They're going to get a better investment return. And the obvious answer is, well, look, I'd love to, but I don't have the shekels to buy a bunch of quality family homes. And it's like, well, here's one I prepared earlier. Thankfully, we do. So here's a portfolio of quality family homes across Sydney, Melbourne and Brisbane, across price points, but all of which are targeted for their likely capital growth potential.
And Evan, you talked about the liquidity in terms of selling or buying back, and you're at 40 odd now. Where do you think that tipping point becomes, and how many homes do you look for?
The first fund, we're aiming to have 200 homes.
Yep.
So I think from a diversification point of view, just with the first 40 assets, I feel that we're really, really beautifully diversified across all of those markets. We'll get a little even deeper diversification across 200 homes. But the principal reason of going to about 200 is at that scale, you can start having reasonably statistically predictable levels of churn in the portfolio. So the self-harvesting becomes reasonably predictable. And we've seen this from similar funds in the US where, interestingly, the proportion of the homeowners who buy out the fund is much higher in the US than we were predicting. So if that turns out to be true in Australia, then it will harvest itself even faster than we had anticipated.
You're 9 years through the journey, and we do a podcast next year, 12 months' time, it'll be 10 years that since inception of Longview. Where would you like to see the business go in the next 12 months?
Well, I profoundly believe that this country needs a housing fund industry, and I believe we will have one. And, some visionary people created a super fund industry that's the envy of the world 40 years ago. They created it 40 years ago. It's now the envy of the world. I hope 10 years from now, Australia has a vibrant housing fund industry, and if Longview's good enough, we've got pole position, then hopefully we'll earn the right to be the leading player, the blue chip player in that space. And if we're successful doing what we're doing, I'm sure there's a lot of other people who come in after us, and that's good. So that's what we're hoping to do. We've launched our first shared equity fund. We'll be launching a rental property fund next year.
Okay.
But if you look at the US, for example, in rental homes, the single family home funds in the US didn't exist 15 years ago. They've now got about $150 billion to $200 billion under management. Wow. The biggest of them have 100,000 houses each, right? The shared equity funds in the US, most of them are 7 to 10 years old. They've got over 10,000 homes in them. They've delivered 17 to 19% returns to their investors. So Australia's a different market to the US, and we didn't build this trying to mimic the US. We actually only found out about what's happening in the US after we'd already built what we were doing from first principles in Australia. But, you know, it's a knowable thing. And if you look at the housing solutions, if you look at institutional ownership of housing in Northern Europe, for example, dignified, secure, long-term rental environments where people have a place called home, they can live there for a long time, they can get to know their neighbours, they can put down roots, they can keep their kids in the same school, they can paint their daughter's bedroom any damn colour they like. So, you know, we want to see dignified, secure housing solutions, whether in owner-occupiership or in rental. And we want a large-scale housing fund industry that delivers good returns to investors to finance that.
Fabulous, Evan. Thank you so much for being on the podcast today to talk about your journey, the Longview journey from before Longview to where it is now, the 9 years in. I congratulate you on the journey thus far. Obviously, a big market ahead, as you mentioned, in terms of replicating the US market. All the best, and look forward to catching up again.
Terrific. Thanks very much, Chris.